Now, what is vertical analysis? Vertical analysis, now, when we think about horizontal analysis, is the same line item across time looking horizontally. Vertically is looking on one specific years of financial statement. So here I've given a really simple income statement with sales, cost of goods sold, gross profit, minus expenses equals net income. So you got those 5 main column headings or row headings there. And I've given you the numbers here. And what you're doing in vertical analysis is comparing different line items to one other line item that is kind of like the total for the financial statement. So under the income statement, we're going to compare to sales. Let's get a new marker here. That's not working too great. So under the income statement, we're going to compare to sales. And when we do this for the balance sheet, we're usually going to compare it to total assets. So you'll see that in the examples in the chapter. So what would we do here? We would have the component percentage. If we would have a financial statement where we just had the actual numbers here, and then we would have some vertical analysis going on saying what percent of sales are each of these items here. Well, obviously, sales as a percent of sales is 100%. So you'll always see that starting out there for the sales item. But let's just look at gross profit, net income. The calculation is also really simple for your vertical analysis. You'll just take the actual line item divided by whatever your base comparison is. So we'll take the 350 divided by 1,000. What's that percent? Well, our gross profit rate is 35%. That would be our rate right there. What does that tell us? Well, for every $1 of sales that we made, we got 35 cents of gross profit. Remember, this is what it costs us for the product. This is what we're making in excess of the cost on our sales. We also have to cover our other expenses, manager salaries and sales salaries, those type of things, electricity. That's down here in expenses. So now we have a lower number for net income. Let's figure out what our component percentage for net income is. 75 divided by 1,000, and that's 7.5%. Okay, so these are two numbers that people frequently look at as far as your component percentages or your vertical analysis to determine how efficient and how profitable a company is operating. So what does this percentage down here tells us? For every $1 of sales that we have, we're making 7.5 cents of net income. Now, is that a good number or not? Well, how would we determine that? Well, we would determine it, one, based on what our percentage was in prior years. If we had a 12% net income rate here, then that would mean we went down quite a bit and we were less efficient this year. We would also compare it to what the industry standard are. What are our competitors reporting? If this is Burger King and we're looking at McDonald's and McDonald's only has a 6% net income rate, then we're performing better than McDonald's. So you could do this to compare different companies. If you had 3 different financial statements, like 3 different competitors, you had Wendy's, Burger King, and McDonald's, you could do these ratios and say, well, as a percent of sales, how is their net income going? And you can do other things like your horizontal analysis across different companies to compare which one's stronger than the other, which one would be more worthy of your investment. Let's continue on looking at some ratio analysis. Now, there's 5 different types of ratio analysis that the book covers. These are on page 565. And I have that here in front of me. There's all different types with liquidity, efficiency, solvency, profitability, and market prospects. Now, the study guide gives you examples of what each of these is trying to determine. Now, the word liquid means, are we able to pay our obligations as they come due? So usually some of the things you see in liquidity ratios are current ratio. So you compare your current assets to your current liabilities. And usually if you have a current ratio of greater than 2, that means you're in strong shape because you have 2 times as many assets, 2 times as many current assets as you do current liabilities. So you're able to pay your current liabilities as they come due. What's efficiency? Well, a lot of these include inventory turnover, accounts receivable turnover. Are we efficient in running our operations? How productive are we in using our resources? Those ratios are listed there as well. Solvency is more long-term version of liquidity. So are we able to cover our long-term obligations, including like our long-term debt, things that are not due within a year, but are going to be necessary for the long-term operations of the business. Profitability, this is usually based on your income statement. So how are we using our capital to return a profit? And the examples there are profit margin ratio, earnings per share, those type things. What you want to do as you look through these, as I noted right below that, you don't just want to know how you actually calculate that. So you don't want to just always refer to the cheat sheet. So you want to know how to calculate it, but you also want to know what they're used for and how to analyze it. So just because you get a number of 13%, is that a good ratio or is that a bad ratio? Well, it depends on the context and the historical performance. The last one is what they've grouped as market prospects. So price earnings ratio, dividend yield, PE ratio is something that you're going to frequently see quoted if you go look up a stock on Yahoo Finance or something along those lines. It basically compares how much the company made in the prior year to what it's currently trading at. So that tells us how what the market views of the stock. So Google, for example, is like the hot stock and trading at several $100s, $400, $500. But their earnings aren't really anywhere near up to that level. So they might have, I don't have the numbers in front of me, but they might have a earnings per share of $10 for a year, but they're trading at $400 per share. So that would mean a PE ratio of 40. The market is saying this stock has so much potential for the future that we're going to elevate it. It has a high PE ratio, has a lot of future potential when you compare it to other stocks that have a low PE ratio, that the market is going to require them to produce earnings in order to raise their stock price compared to what a potential hot stock might report. So there's more examples of those and explanation in the chapter, so make sure you read those. See if there's anything else on chapter 13. I think we covered it all. Make sure you look at page 565 for the ratios and then understand what we're doing for horizontal and vertical analysis. On chapter 14,